I want to focus on the policy and not the politics, but it hasn't stopped anybody trying to work out what the politics means for policy. How have you been thinking about that this week, Luke?
Yeah, I guess I have. The thing that worries me a little bit is our experience over politics over here in the UK is the messier they get, the more risk it puts out in the general economy. And when the US arguably over the next 18 months, 2 years, could be facing a recession, it increases the risk of that happening. So it just doesn't feel like something you can walk away from and entirely ignore. It feels like it's going to be part of our lives for a while here, and it just increases those economic risks.
Mike Collins, it's something really, really difficult to ignore. It's going to be a part of our life, but it's really, really complex to handicap. How on earth do you do that?
So we're trained as fundamental research analysts, analyzing bonds and companies. So political analysis, especially with people like Trump, is really difficult, right? So our base case is that you don't get a recession, right? I mean, the U.S. certainly doesn't feel like we're in the speculative bubble type of environment. So, you get lower growth, lower rates, moderate inflation, and we actually look forward to more volatility in the markets. We hope that this political noise actually creates some pockets of volatility and opportunities to be more tactical and active.
What's your take, George?
Certainly could use a little more volatility in the markets. It's an opportunity. From our perspective, it's one of two things. It's either a distraction or it's a catalyst, right? A catalyst to sort of getting some trade deals done with the U.S. and China potentially. That seems a little bit far-fetched. We think it's a little bit more of a distraction right now. I think what things is being lost in this is a little bit of the USMC. Could it be a distraction to that? Because if that gets through the USMCA, that could add 0.5% to GDP. And when you're coming off a year when you have, the pro-cyclical features coming off, 0.5% to GDP could be pretty significant.
Some of these big issues are incredibly volatile from one day to another. I caught up with PIMCO's Joachim Fowles and tried to get the baseline from PIMCO on what they were looking for in 2020, looking for 1% growth in the next year. Take a listen to what Joachim had to say.
We see US growth slowing to something like only 1% in the first half of next year as the slowdown in manufacturing, actually the global trade recession, is starting to spill over into the US service sector and the US consumer. During a period of low growth, during a period of stall speed, obviously the economy is very vulnerable to any adverse shocks.
Luke Hickmore, are we ready for 1% GDP growth in America going into 2020? Is that your baseline?
It's certainly mine. I think our economists are a little bit above that, but I think the risks of that getting there are very, very high. I mean, we've talked, Jonathan, over the last year or so numerous times about how the 2s-10s curve is such a good predictor of slowdowns and recessions. We can't ignore that. We can't ignore the consumer's probably at the best they're going to be at the moment. Employment's at the best it's going to be at the moment. We can't ignore that. And actually, our US colleagues have been moving underweight US investment grade credit for the first time in decades. So yeah, it's going to be a problem. We are going to see slower growth, and we're starting to react to it right now.
Mike Collins, what are your thoughts on the matter?
Yeah, I mean, growth is slowing, right? So it was 3% last year. It's going to be maybe 2.5% this year. We think it's actually going to be maybe the high ones next year, but it's on a slowing trajectory. And I think people who say, is there going to be a recession or not, are missing the point, right? It's not necessarily a binary outcome. Slow growth is bad for highly levered credits, right? And we've had obviously a big relevering in corporate America, globally in credits, and 1% growth is going to be a really challenging environment for a lot of companies.
What do you think, George?
Yeah, 1% is a little bit lower than our base case. Our base case is high ones, 1.7, 1.8. So yes, the trend line is disturbing, right, and concerning. And certainly the bond market is telling you from that inverted yield curve that there's potentially challenges ahead. Not a baseline of a recession, but certainly a slowdown is what we're seeing.
We're always focused on the shark closest to the boat. The shark closest to the boat this week has just been incredibly volatile politics down in Washington, D.C. It's interesting that what has hardly been spoken about is terrible PMIs in Europe. We looked at them for 5 minutes, we moved on. A German business confidence number that was ugly. South Korean exports, consumer confidence in America, consumer spending in America slightly disappointing as well. You put that all together, Mike Collins, is there still enough appetite out there for duration at these kind of yield levels with the fundamentals that underpin that too?
Absolutely, right? I mean, the slowing growth is the fuel for potentially lower yields. I mean, we actually look at the other side of the data, and there's been some actually pretty resilient results in the U.S., especially in the consumer and services sector. Right? The U.S. just feels like we're going to kind of hum along at 2 or maybe a little bit below 2, but it's really hard to see a sharp slowdown, like a consumer or even business-led slowdown in the U.S., right? So I think we can actually bolster the rest of the world. But if that doesn't transpire, and if you can continue to see weakness abroad, yeah, the 10-year Treasury at 170 has a lot of scope to fall from here.
Luke, what are your thoughts on that matter? How big the demand for duration will be and how insensitive it will be to how low yields are already here in the United States?
It feels, I agree, it feels we could go lower from here. We probably need the Fed to kick in again, and that might be next year now with the Fed rhetoric seemingly changing recently. And actually, you know, right here, right now, the data's improved a little bit better than people have been expecting. If you look at things like the Citi US Economic Surprise Indices, it's been pumping up a little bit recently. So we might get a bit of a pause for that. We might get August feeling okay, and the numbers around that in September as well feeling okay. But it feels that that's going to be a short-term relief. I think the problems that are building up in the US economy are enough that we will be talking about sub 1% growth pretty regularly next year, and that means duration's a great buy from here.
Final word, George?
I think right now the direction for rates is down, but I don't think it's necessarily down as significant maybe as some of my counterparts, but I do think that sort of a neutral view on duration is probably the way you want to be right now. And so you're going to see things tick down in a kind of gradual manner right now.